when the Fed indicated that it was going to be firm but intelligent in its monetary policy, that caused oil prices to decline, the stock market declined, the dollar declined, and gold rose. Partly because I guess the gold market perceived, okay, interest rates are not going to rise any further. Inflation is going to come down, but there are a lot of problems there. Good afternoon. It's Jeffrey Christian of CPM Group. It's just after 12, about 12:15 on Cinco de Mayo, the 5th of May. Want to talk about the markets a little bit. Gold hit a record price yesterday on an intraday Comex basis of $2,085.40. That was a record. It surpassed the previous record that was set in early 2021 after the Russians invaded Ukraine. The price did come off about $30, $29.70, I believe, to settle around $2,055 yesterday. And then this morning it came off even more sharply, got down to about 2007 at the last time I looked in late morning. The price increase was predicated partly on the Federal Reserve Board's Open Market Committee statements on Wednesday, the 3rd of May. The Fed increased interest rates another 25 basis points, as it had said, and as the market had believed it and accepted it would happen. But in the comments afterward, Fed Chairman Jerome Powell made several comments that were very important. First off is he said that they have changed the language in their statement to indicate that they will change interest rate policies and levels in the future based on the economic data that comes out, and that they didn't necessarily anticipate increasing interest rates again at the next FOMC meeting. Rather, they sort of thought that they'd probably hold interest rates steady now through the rest of this year until such time as they saw a significant weakening in the U.S. economy that warranted it. They are seeing inflation rates come down. Inflation rates are still higher than they want and everybody else wants. So they want to maintain interest rates relatively high while they try to quell inflationary pressures without throwing the economy into a recession. And the other significant part was he pointed out that while the economic projections that are published by the Fed, which are notoriously inaccurate and don't come to pass, suggest that there could be a mild recession later this year. That was not his view, and it was not the view of other people who are on the Federal Open Market Committee, that they all have their own views. His expectation was that real economic activity would remain positive but low, as it has been really since the beginning of 2022. But that a recession probably lies someplace in the distance beyond 2023. CPM Group's view has been that a recession was likely in 2024 or 2025, but that it could start at any time, and including the fourth quarter of 2023. So when the Fed indicated that it was going to be firm but intelligent in its monetary policy, that caused oil prices to decline, the stock market declined, the dollar declined, and gold rose. Partly because I guess the gold market perceived, okay, interest rates are not going to rise any further. Inflation is going to come down, but there are a lot of problems there. The price fell further this morning on the 5th of May, partly because of a very strong jobs report, stronger than the market expected. And as we always say among ourselves here at CPM Group, stop paying attention to what the market expects and pay attention to what the economic data are showing you, because market expectations often are not quite right. So I want to talk a little bit more about this and the gold market and everything, but first let me reply to a comment from an earlier CPM video. Someone had indicated in his comment that mining companies, producers, ought not to be price takers on the Comex for their gold and silver that they're selling, but rather they should try to engage in a market process or an auction process in selling their gold and silver. I just want to clarify that. I don't know, and I've only been in this business for about 43, 44 years. I don't think I've ever met a producer. Well, there was one, but they don't exist anymore. I don't think I've ever met but one producer that sold its gold or silver on the Comex. Most producers, and all of the ones except that one back in the 80s that I know of, sell their gold and silver to banks, or trading companies, or dealers, or refiners, or smelters. And they usually price it, often they price it either at a spot price that their counterparts give, or at the fix, or the replacement for the fix, the London fix. Now, the fixes and their replacements are auction processes, where by companies that buy and sell gold and silver and platinum and palladium for others get together electronically now, and they say, well, I have clients who want to buy this much, and I have clients that want to buy that much, and it comes together into a market clearing price, a price at which this give and take among actual physical buyers and sellers of actual physical metal. Yes, they are physical buyers, but they also are buyers and sellers of physical metal. So it is, if you're selling at the fix, which is quite often the way that producers do sell, you are selling through an auction process. Other producers will deal directly with companies on an intraday basis, and they'll call up one or two or three banks or dealers or trading companies that they have trading lines with and credit lines with, and they'll say, what's your price today? And then they will sell at the highest of the prices. And they might have two or three different companies that they have trading lines with so that they can deal with it. There was a gold mining company, a very large gold mining company that we worked for from the time we were created in May of 1986 until maybe about 15 years ago when they stopped using us as advisors. That company we actually worked with prior to the creation of CPM Group, because they were a client of J. Aaron and Company, and then they were a client of Goldman Sachs, which is where we were the research department until we spun off of Goldman in 1986. We knew that company traded with one bank. And in the mid-1990s, the CFO and CEO, who had changed, they had a new CEO, is, how do we know that we're getting a good price? And we said to them, you have to ask more than one bank. You should have two or three or maybe even four companies that you call, that you have trading lines with, and you call them and say, what's your price today? And then you take the best price. And that's how you know that you're getting a good price. This was the mid-90s. And when we stopped working for them around 2008, we knew that they still were only trading with that one bank and getting one price quote on a daily basis. And that doesn't give you an auction process. But most producers that we know either price it out on an auction basis with two or three trading counterparts, or they sell through the fix. So that's the way the big guys sell their gold and silver. So we're at a record gold price. We are close to record gold prices. If you look at it on a quarterly or a monthly or an annual average basis, we're pretty much at record prices. CPM Group's expectation is that the price could see some short-term selling. I mean, we've already dropped $78 from yesterday's high. We could see a little bit more weakness in the near term. The fact that you have a lot of problems still out there, the fact that you have the debt ceiling discussion / impasse continuing, which is already, even if they avoid a default, the U.S. government, Democrats and Republicans, administration and Congress, have gone to great extents to depreciate the respect that the government of the United States has for its fiscal policy. I mean, this is a joke, and it's a bad joke. I will say that in our precious metals advisory, which we put out yesterday for May, we did refer to the fact that in the mid-1990s, during the Clinton administration, when you had a Republican Congress, the Republican Congress tried to hold the debt ceiling as hostage, and they shut down the government for a while, and it looked like the government was, at where it is today. We may run out of money within a month or 3 months or whatever. And Secretary of Treasury at the time was Bob Rubin, who had worked at Goldman Sachs when I was there. And Rubin was having a press conference, and one of the reporters said, "What are you going to do?" And he said, "Well, there's a lot of things that we can do." And he didn't go through the litany of the more likely ones, but he knew the touch point. He said, if we really needed to, we could sell some of the 261 million ounces of gold that we have in the U.S. Treasury. Well, the gold-producing states primarily had Republican congresspeople and senators. And within a couple days, those congressmen and senators from gold mining states had decided to allow for the debt ceiling to be increased rather than run the risk of a Democratic administration selling some of the gold in order to raise cash to run the government in a deficit way. I don't think that the Biden administration will make that threat this time, but it might get a few of those people off of the mark and get them to focus on it. But we do have a risk, and even if we avoid a default, we are going very strongly to convince people that the administration and Congress of the United States are fiscally irresponsible. And they're playing politics with that. And that's bad. So gold prices will probably stay high in the next several weeks. They could come off a little bit more on profit taking after yesterday. But even with that profit taking, we think that prices could stay high until the debt ceiling talks are resolved. And that could extend through May. It could go even longer. I doubt it will go beyond May. Once we get beyond that, and assuming that nothing else bad emerges, you may well see the gold price and silver prices come off June, July, August, possibly into September, before we do expect them to continue to resume their rise and move to higher record prices in the fourth quarter of this year and in 2024. What we're seeing, I'll just show you one chart, which is the gross long and short and net positions of institutional investors on the Comex gold contract. And you can see it's relatively high. I mean, it has come off from where it was in the second half of 2019 and 2020, but it's still very high. On a gross level, you're close to 30 million ounces of gross long positions. The short positions are around 10 million ounces. So you have a net position and 15 to 20 million ounce net long position on the part of institutional investors. So this is just one measure of something that we've seen across the board and around the world of investors being still very much interested in gold. Central banks are also interested in gold. We, in our May Precious Metals Advisory, we have data through March. In the first quarter, the net purchases of gold by central banks was about 3.3 million ounces. In last year, total central bank purchases were net about 10 million ounces. So we're running about 13 million ounces. We're running up about 30% higher than we were a year ago. Silver prices are high. Investment demand is relatively strong. It's spotty, but the price is lagging gold. It's not at the price highs that we saw in 2020 and 2021, and even early 2022. And it's definitely not back to the records that we saw in April of 2011, just shy of $50 an ounce, about $49.95, I think was the intraday high in April of 2011. So silver prices are not as strong as gold, but they're still pretty strong. And investment demand, we've seen some declines in some sectors, but we're seeing relatively good demand in other places. So we've seen net ETF additions. Investors are buying ETFs. The demand for coins and medallions seems to have waned some. And here you can see the net and gross long positions on the Comex futures contracts, and you can see a sort of a steady decline. Now, May was an active delivery month. May is an active delivery month for Comex futures, silver futures. And we have seen through yesterday, through May 4th, most of the delivery notices are handed in within the first few days of trading. And we saw about 9 million ounces of silver futures contracts delivered and taken delivery of during that time. We've seen around 2 million ounces of that actually be physically taken out of Comex depositories. So Comex depositories were about 33 million ounces, 33.3 million ounces. They're about 31.3 million ounces now. So it's a little bit less than 2 million ounces of the silver that was represented by futures contracts for May delivery have actually been delivered. And the residual amount of May contracts is very small right now. Of course, somebody could come in and buy a spot contract and take delivery, but that's highly unusual and probably shouldn't be expected. Let's see what else I have. I put the gold and the dollar up. The dollar has shown some weakness over the last few days and really since November. It's actually come back a little bit since November, because the dollar and gold are the places where the world runs to, the assets that the world invests in when things are bad. And we are seeing investors, large institutional investors, family offices, small investors around the world saying, I think I should have more gold and silver in my portfolio at this time, given the state of the world and the state of my individual country. We had another question which came up in response to one of our videos, and it said, can inflation decline in a negative interest rate environment? And the answer is yes. Empirically, we've seen this. If you look at this chart, the red line is real U.S. Treasury bill rates, and the blue line is inflation. And you can see actually from late 2002 until now, we have seen mostly an extended 21-year period of negative real interest rates. Interest rates, less CPI, but negative. And you can see that during that period of time from 2002 to 2021, early 2021, we actually had low inflation And we actually had declining inflation. And the decline in inflation occurred really from like 2011, 2012, the end of the European sovereign debt crisis, the U.S. Treasury funding issues that led to a downgrade of the U.S. Treasury's credit rating in August of 2011. We actually saw interest rates fall during that period of time, inflation fall during that period of time when you had very large negative interest rates. So empirically, it's there. Theoretically, there's also support because, as we've said repeatedly, if you look at the causes of inflation, unless you're one of these dogmatic monetarists who thinks that all inflation and all economic activity, the only factor that affects it is interest rates and monetary policy, and that's pretty much been discredited since the 1970s. Most people don't believe it. Most people know statistics don't support that view. There are a few people who still believe it, apparently, but they ought not to. If you look at the causes of inflation, monetary policy, interest rates, and the provision of money are a factor that can cause inflation to rise or fall. But it's only one of many factors, and it's possibly less influential in inflation rates than are other factors. One of them is the supply of goods and services, the relative scarcity or abundance of goods and services in the real economy. Another one is the level of demand for those goods and services relative to the supply of them in the real economy. A third one is fiscal policy. And a lot of inflation has to do with fiscal policy and not monetary policy. So you have like 4 sets of factors that really influence inflation. And monetary policy may be the least important of those 4. Bottom line is that we don't have to worry. We can see inflation rates decline in a negative interest rate environment. It's happened before. It's happened for most of the last 20 years, and it probably will happen going forward because we still expect interest rates to remain negative on an inflation-adjusted basis for a while yet. We will be releasing our Silver Yearbook for the 2023 on May 16th. There will be a free online briefing. You can sign up at our website, cpmgroup.com, for that. You can pre-order that book. You may also order the Gold Yearbook, which came out at the end of March. And then we'll have our Platinum Yearbook in the middle of July. Next week, we may not have a Tuesday video. I have to figure that one out because there is a conference on Monday through Thursday here in New York where Rohit Savant, who is our chief, he's the director of our research department, and he's the chief author of our yearbooks and our precious metals advisory and most of our precious metals research. He will be speaking at the Society of Mining Engineers conference on current trends in mining finance, and I will be speaking at that too. Other people can join. I think it's a small fee to attend. You can go to this website at the Society for Mining Engineers, and you can sign up. And you can go to our website, read other free reads, order books, order yearbooks, order reports, become a client of ours to either through the retail investment program, investor program, or through one of our other services that we offer. That's all I have for now. Like I said, I may not have a video on Tuesday because I will be at that conference, and it'll be pretty intense. We'll talk to you next week. In the meantime, take care of yourself and those around you, and try to do something good for the world.